Welcome to the Pro Ticker Deep Dive. Today, we are setting the scene not in the boardroom, but actually inside the modern American shopping mall. If you walk into a typical mall right now, you are watching a tale of two vastly different retail realities unfolding at the same time.
It's a fascinating split, and the difference is it's stark. On one side, you've got the highly focused specialty stores,
Yeah.
the chains that are all about one category or one kind of customer.
Well, they're expanding.
They're expanding, they're delivering growth, and they are pouring money into next-gen tech. They look energized.
Absolutely. But then you look, right across the corridor,
Mhm.
and the traditional department stores, the anchors, the generalists, they are just struggling.
Oh, massively.
They're closing locations, they're grappling with all this legacy debt, and really, they're fighting for relevance in a market that feels like it's completely moved on.
And that's really why we're here today. The traditional idea of retail as this one, big monolithic category, it's dead. It just doesn't apply. Our mission is to unpack the hard data behind what we're calling this great divergence. We want to understand precisely where consumer spending is flowing, and maybe more importantly, why one model is thriving while the other is, frankly, struggling to survive.
And this is so critical because what the data is showing us isn't just, a typical cyclical weakness that's going to reverse next quarter.
No, not at all.
The investment paths we're seeing in 2025 suggest a deep, a tectonic shift in how consumers behave and what it even takes to compete.
They absolutely do. When we just look at the initial data, the scale of the problem for these generalists becomes incredibly clear. Specialty retail, which, by the way, already accounts for nearly 24% of total U.S. sales, is enjoying annual revenue growth of around 4%.
Which is solid.
It's solid. And even more critically, 3% comparable sales increases.
And just for our listener, when we talk about comparable sales, we're talking about sales at stores that have been open for at least a year, right? This is the real measure of health.
Exactly. It's the true measure of customer engagement, totally separate from just opening new stores. It shows real organic demand.
And the department stores.
It's a different story. They're hemorrhaging. In the first quarter of 2025, their comparable store sales declined by a painful 4.2%, with overall sales down 2.5%.
Wow.
That isn't a fluctuation. That's a structural divide opening right up beneath them.
Okay, let's unpack this then.
Yeah.
If you are a generalist trying to cater to everyone, why is the market punishing you so hard right now? What are the macro forces that created this environment, one that just so heavily rewards being nimble and specialized?
It really feels like a perfect storm, doesn't it?
It does.
It was a collision of three powerful, sustained forces. The first, and maybe the least visible one to the average shopper, is the elevated impact of tariffs.
Tariffs are back in the news,
Yeah.
and it's not just a political thing, it's a direct cost issue for these companies.
Precisely. The models are projecting that tariffs will reduce overall U.S. growth by 0.62 percentage points in 2026. But what's fascinating is the link to inflation.
How so?
Tariffs explain a really significant chunk. We're talking 10.9% of headline consumer price inflation over the last year. That cost has to land somewhere.
That's a staggering number. It means tariff policy is actively driving up the prices we see on the shelf. So how does that hit the generalist versus the specialist differently?
This is where the business model really matters. Large, undifferentiated department stores, the ones that rely on huge quantities of imported goods, think home goods, apparel, they bear the full, brutal brunt of these costs.
So it crushes their margins.
It leads directly to margin compression. The gap between what they pay for an item and what they can sell it for just shrinks and shrinks. They can't easily raise prices because they're competing on price.
They just have to eat it.
They eat the costs. Specialty retailers, on the other hand, they manage much better. They have smaller, more concentrated sourcing, and more importantly, they have stronger customer loyalty. That allows them to make strategic price adjustments without, losing their entire customer base overnight.
They've built an economic buffer. That makes perfect sense. And that brings us to the second force, this consumer spending polarization.
Yes, the widening gap between affluent and middle-income shoppers, it's creating two very distinct lanes for retail winners.
So you win at the high end or you win at the value end?
Absolutely. The market is fracturing. On the premium side, specialists that project authenticity are thriving. We're talking about companies like Abercrombie and Fitch.
Which has had an incredible run.
An amazing run, up a remarkable 42% year to date. And Urban Outfitters, up 28%. Affluent consumers reward that kind of exclusivity and brand story.
They're not looking for the cheapest thing. They're looking for the right thing, the thing that reflects their identity.
That's spot on. And on the flip side, you have the value retailers, the dollar stores, capturing the really cost-conscious consumer, and the department stores,
Stuck in the middle.
stuck in that vulnerable middle ground, trying to serve everyone, and in the end, succeeding with no one. They just lack a clear value proposition.
And the third force here is just cautious consumer sentiment. The sentiment index is near 50-year lows. When people feel uncertain, they get ruthless about where their money goes.
That selectivity drives this fascinating pattern we call the smart splurge mindset. Our data shows 44% of consumers are still budgeting for higher priced items, but, and this is a big but, they'll only splurge if it offers a curated, specialized experience.
So if I want a specific pair of running shoes, I'm going to Dick's Sporting Goods, where I expect an expert and a huge selection, not the department store that has like one shelf of generic sneakers.
Precisely. Department stores default to heavy, untargeted discounting to move inventory, which just erodes their margins and their brand. Specialists capitalize on that demand for curated value.
This is where it gets really interesting for me, because this approach has translated into real operational advantages, creating a competitive moat. And it's nowhere more visible than in e-commerce.
It's a staggering gap. I mean, it just speaks volumes about their tech capabilities. Specialty retail e-commerce is surging, up 29% year over year.
And department stores.
And they're lagging badly, stuck at only 8.3%. And this isn't an accident. It reflects their chronic inability to execute a modern omni-channel strategy.
I see this term unified commerce a lot in the research. Can you just break down what that means in practice?
Unified commerce basically means integrating every single channel, online, app, physical store onto one platform that shares data in real time. For you, the customer, it means you can see inventory seamlessly, you get personalized offers, and things like buy online, pick up in store actually work reliably.
So the company knows exactly what's in the back room, and I, the customer, know it too.
Exactly. And the research shows that 38% of specialty retailers are advancing these initiatives. And here's the kicker. Those leaders are growing 3 times faster than their peers who are stuck on fragmented, old systems.
Can you give me an example?
Sure, look at Dick's Sporting Goods. By extending their premium footwear assortment through their omni-channel setup, they drove a 5% comparable growth in fiscal 2025. They turned technology into a sales driver.
But then you get these cautionary tales, like the chaos at Saks Fifth Avenue post-merger, vendor payment delays, logistics nightmares, a 16% sales decline because customers just gave up and went elsewhere.
It's an extreme example, but it illustrates the point. The fact that a major player's underlying tech couldn't handle that integration just points to a deep reliance on broken legacy systems. When the system breaks, the customer experience fails instantly.
And they don't come back.
They don't come back. Not in this environment.
Okay, beyond tech, the advantage is also really clear in profitability, right?
Uh-huh.
Specifically gross margins. We're seeing 36.5% for specialists versus 32% for department stores. That 4.5-point difference is huge.
It compounds exponentially. And that margin gap is really fueled by 3 core structural differences. The first is that specialists can command higher average selling prices, or ASPs.
And why do we, as consumers, accept paying more at a specialist?
Because we perceive it as value. It's tied to their expertise, their brand. A customer will happily pay, say, $100 for a great pair of jeans at Abercrombie because that price reflects the brand, the experience, the curation. Department stores are just seen as a collection of discounted goods.
Right. And the second driver is private label penetration. This one's massive.
It's a huge lever. Specialty retailers drive 40 to 50% of their total sales through their own private brands. This gives them a margin advantage of over 200 basis points.
Or more than a 2% margin improvement.
Exactly. They control the whole process. Department stores, meanwhile, are stuck with all this third-party national brand inventory that ties up capital and limits their flexibility.
And the third driver is just pure inventory efficiency, which brings us back to tech.
It does. It's all about optimizing stock. We found 81% of specialty retailers investing capital are using AI-powered demand forecasting and dynamic pricing. This lets them predict demand way more accurately and reduce markdowns.
So they don't have to slash prices at the end of the season just to clear out the warehouse.
Precisely. And you see department stores trying to catch up. Kohl's made a huge effort on inventory discipline, but they only managed to expand their margin by a modest 28 basis points. It just shows how hard it is to move that needle when you're starting so far behind. And if we shift focus a bit, this divergence isn't just about sales today, it's about capturing the customer's lifetime value. And here, specialty retail is building what looks like an unshakable moat.
Through loyalty programs, I assume.
Exactly, and that translates into dramatically better retention. Specialty retailers are reporting customer retention rates that are 53% higher. 53%.
Wow.
Their loyalty programs are engagement engines built on data, not just discount tools. They're using personalization, and that's driving membership growth of 35% year over year.
And that data they're collecting must be invaluable for the bottom line.
It fundamentally reshapes their economics. I mean, look at Dick's again. Their loyalty members drive over 60% of their total sales. And those customers have transaction values that are 40% higher than non-members.
So you have a smaller, highly engaged group that's responsible for most of the profit.
That's the model. Meanwhile, department stores programs are just seen as, well, as discount vehicles, a way to get 10% off a generic purchase that doesn't build commitment.
And this is showing up in where people actually go.
Right.
The foot traffic trends from Q1 2025 are incredibly telling.
They absolutely confirm that curated experiences are winning. We see it even inside the mall itself. Nordstrom, which has invested heavily in renovating and curating its stores, saw its foot traffic rise 6.5%.
But the more traditional banners,
Traditional luxury banners that haven't adapted, like Saks and Neiman Marcus, saw traffic declines of around 6%. Customers are literally voting with their feet for a better, more focused experience.
so pulling all this together, what does this mean for the future? For the investment case? We have a clear bull case for specialty retail, but there are still risks.
The bull case is really driven by expansion opportunities that the generalists just can't touch. International expansion, for one, is just getting started for many of them. Abercrombie is planning significant growth in Europe.
And technology still offers a huge upside, even for the leaders.
It does. AI-powered personalization is still what we'd call underexploited. The leaders who use it are seeing conversion lifts of up to 28%. That is massive potential just waiting to be tapped.
And let's not forget M&A. Well-capitalized specialists can now consolidate real estate, maybe even snap up weaker players.
Exactly. They're operating from a position of strength, but, the bear case is still there. No one is completely immune to macro forces.
What are the big risks keeping this segment in check?
Economic recession is the big one. A sharp contraction would hurt even the strongest brands. And those tariffs we talked about are a persistent headwind. Abercrombie warned of $90 million in additional costs just this year from tariffs.
And of course, the constant threat from digital disruptors like Shein, Temu, Amazon.
Right. They're fragmenting consumer attention and offering hyper-low-cost alternatives. It means specialists have to constantly innovate to protect their niche.
Let's touch on valuation, because the market is clearly pricing this divergence in already.
It is. Specialty equities show really robust momentum. Abercrombie's stock being up 42% year-to-date is a direct reflection of these operational successes. These stocks now command a 15 to 20% valuation premium, and investors are justifying it based on their superior margins and growth runway.
Meanwhile, department store stocks are seen as value traps.
They really are. They look cheap, but there's a reason. Take Macy's. They had a strong Q2 earnings beat, which led to a very modest 8% bounce. But the stock is still trading at a huge discount because the market just doesn't trust that they can sustain growth long term.
So the market has spoken. Margin power and specialization are worth paying a premium for.
To sum it all up, this great divergence in retail isn't temporary. It is a fundamental, probably permanent reshaping of the landscape. Specialty retailers have captured the high ground on every metric that matters: loyalty, margins, technology, and cultural momentum. Department stores, sadly, have become warehouses of yesterday's compromise.
So the market thesis is pretty straightforward. On the specialty retail leaders with proven omnichannel skills and a strong private label strategy. Avoid the big bloated chains trying to restructure. The key lesson here is the power of specialization and using data to build trust. And the provocative thought we want to leave you with is this. Consider what adjacent industries, maybe regional banking, professional consulting, might soon face a similar tectonic shift, where trying to serve everyone inevitably leads to serving no one. And think about how you can apply those principles of focus and specialization to your own field.
That's the critical takeaway that goes way beyond retail.
See you all in the next Pro Ticker Deep Dive.